Hi, thank you for joining us here at Tax Talk UK, where we talk about all things tax and other important aspects of running your small business and working for yourself. Today, I'm going to talk a little bit about double entry bookkeeping. Before I do, if I could please ask you to take a moment to subscribe to our YouTube channel. That way you will easily be able to refer back to this information if you need to, as well as being able to find other information available to support you in your self-employment, which is all categorized in our playlist. So if you go to our playlist and look for your trading style or your situation, there you will find the information that we have provided to support you in your situation. And of course, if you do find this information helpful, please do take a second to like the video so we know that the content that people are finding useful and what topics people would like to hear more on. So back to double entry bookkeeping then. So this is a bit of a deep conversation for us to be having, but people are asking about this and what they need to know about it. So what I'm going to do is just give an overview, and bear in mind that I'm talking about double entry bookkeeping from the context as a small business owner or self-employed, maintaining your accounts in your MTD software, for example. What do you need to know, and what information would it be helpful for you to understand about double entry bookkeeping in order to help you to keep your accounts better. So of course there's lots to say about double entry bookkeeping, but given that this is intended for an audience of small business owners who just need to really know a really basic overview so far as will support them in their entering of their information and keeping their accounts. So I'm not going to go too deep. So essentially, obviously in the days before software, a bookkeeper would keep accounts manually. So all the records would go into what we call T accounts, and then they would be transferred to a trial balance, and then from the trial balance we can then produce a profit and loss and a balance sheet. So of course, ultimately, if you're using software to maintain your accounts, you will be looking to produce a profit and loss and a balance sheet. So much as we don't have to record every transaction manually on paper anymore and manually construct the trial balance, ultimately what your software is doing is doing all of that for you and compiling the trial balance, and from that the profit and loss and balance sheet for you. So it is helpful for you to have an understanding of how it works, because the entries that you are making into your software will effectively, your software will be doing the bookkeeping and the double entry side of that for you, but it is still happening. So one of the really important things for you to understand is that when you enter a transaction, is you're trying to achieve a certain thing, or record a certain thing by entering that transaction, but it will have impacts on other sections of your accounts. And this is where an overview into double entry bookkeeping can help you, so that if you're perhaps not 100% certain that you're entering your transaction in the right way, or that you're doing the right thing, that you have enough understanding to think, okay, well, I'm going to look what else in my accounts and was affected by that transaction to make sure that it's correct. Because without doing so, what can happen is over time you're entering these transactions that you presume are correct, but they're having horrendous bad effects on other aspects of your account. So ultimately, this isn't helping you to achieve the goal of an accurate set of accounts. So ultimately, you want an accurate profit and loss and balance sheet for your business for the end of the period that you're reporting on, and hopefully you're looking at those reports on a regular basis throughout the overall accounting period as well. So what is double entry bookkeeping? So one way that I like to think of this is that each transaction in your in your accounts is going to have an effect on the profit and loss and the balance sheet. So everything that you do, everything that happens financially, accounting wise in your business will have an impact on your profit and loss and your balance sheet. So therefore, if you imagine, for example, if you make a sale, so you make a sale and that is going to increase the sales in your profit and loss, increase your profit, and that's going to what's going to happen on the profit and loss side. But also, if you think about it, when you make that sale, perhaps your customer pays you straight away at the point of sale. You make the sale and they give you cash, or they put the money into your bank account immediately. So on the balance sheet, you've made your sale, but on the balance sheet side, if they pay straight to your bank, for example, you're increasing your bank balance. So you're increasing the assets of your business. And therefore, this is the other side of that transaction. Now, of course, if that customer doesn't pay straight away, perhaps it's a client who you have terms for and they don't have to pay for 30 days. But in the meantime, so you don't have anything in your bank yet, but your debtors, your accounts receivable figure, whichever terminology you use, that will increase by the amount of the sale, and thus this is affecting your balance sheet. This is the effect on the balance sheet. And then, of course, if you imagine when that customer pays, then it's moving the balance from the debtors to the bank, assuming that they pay into the bank account. So yes, so everything that you do will have an effect on both sides. And then the same if you make a purchase. Of course, you pay your supplier, for example. Then you've made a purchase, so that is going to be added to the expenditure on your profit and loss. Therefore, it's going to decrease the profit of your business. And on the balance sheet side, if you've paid straight away from your bank, for example, then that is going to reduce the balance of your bank account, thus reducing the balance sheet overall. And the same as what we talked about with sales, if you have terms with your supplier and you're not paying for that purchase straight away, then in the interim, that initial transaction is going to go from the so it's going to be the purchase on the profit and loss, and it's going to be your creditors or your accounts payable that is affected on the balance sheet. But what you can see is in both of those basic transactions where you made a sale and you had a purchase, both of those transactions you can see, regardless of whether you pay straight away or not, each of those has an impact on the profit and loss and on the balance sheet. So this is the important thing. If you're presented with an unusual situation and you're thinking, well, I'm not quite sure here, if I'm entering this transaction correctly, it's always to remember that you're either, unless you're simply moving items between the categories, every transaction, everything that happens will impact on the profit and loss and the balance sheet. So you need to think when you're entering the transaction of the impact on both of those from what you're actually entering. So hopefully this gives you a basic, and it is very basic, but I don't want to go too in depth, because ultimately, as a small business owner, you just want to know enough to be able to ensure that your accounts are accurate. And we will explore some of the specific scenarios we've been asked about in other videos, but hopefully this helps you to understand how everything you're doing is affecting the profit and loss and the balance sheet. And thank you very much for watching. As I mentioned, please do take a moment to subscribe to our YouTube channel. Thank you. Goodbye.